Does not? Okay. Well, we'll go ahead and call this meeting to order, the Pension Retiree Business Board at 5:53 p.m. The clerk, call the roll.
You have a function key when you mute it?
Is your speakers on the computer as well?
Speaker is off.
Yeah, and mic is off?
And my mic is off. Roll call. Ellen McCreary.
I don't know if you guys can hear the significant feedback. It just stopped.
I can hear you. I just don't know why it's doing it. Nobody has their mics on. Ellen McCreary's absent. Marcus Wright.
I can hear her speaker. We can hear her laptop.
Any better?
Testing.
That's better.
Yeah.
Gary Madison.
Present.
Esther Clark. Here. Okay.
We have on our agenda appointment vice chair, that was taken care of in the last meeting, and that's recorded in the minutes from July. That's required. And is there any public participation in our meeting? No? Hello? Just observing? Okay. All right, to the minutes of, July 23rd meeting. There was second. Okay, that'll say. All in favor of approving July minutes? Aye.
Aye.
Any opposed? No. All right, reports. I think the reports in order is listed. Melissa's up first.
Great. Well, good evening, everyone. You should have a hard copy of the report for the month of July that was delivered by our Assistant Finance Director, and an electronic copy in your email. Obviously, this is the beginning of the year, so we have 1 month to report. We started the year, again, looking at page 2, the market value of investments. We closed the year with $264.2 million in our pension assets and $17.9 million respectively for OPEB. We closed July for pension at $262.9 million. I will note the town and the board have met their ADEC, their annually determined contribution for the pension fund. The town wired $25.4 million in 3 installments in the month of August, and the board paid their pension ADEC of $370,000 on August 15th. So you will see those contributions in the month of August. Just starting July, we obviously see some losses. We obviously would have paid our pensioners. We'll hear a little bit more from our investment team as to what July looked like from a market performance perspective. And then OPEB, we closed at $18 million. It was a pretty flat month, if you will, 17.9 to $18 million. We did make our OPEB contribution for the town in the month of August, around August 15th. That was $1.5 million. That was sent to Schwab. And, National Transportation contribution to the town. Fully in compliance with our pension ADAC, as well as what's necessary from an OPEB contribution perspective. Now let's take a look at the OPEB trust analysis. We had 1 month of activity. Just a reminder that last year we had $8.1 million in total revenues. That was both the town and the board contribution, as well as an additional contribution from surplus of $1.1 million. We also had a really strong year in terms of market performance, so our gains totaled $1.5 million. Just for the first month, we have just under $200,000 of revenues, and that really is just our interest. It was a light month on gains, $75,000 in market gains, in the contributions to employees and retirees. As you know, I tend to take a conservative posture beginning of the year with only 1 month under our belt. We will see next month our town and Board of Ed contribution of $6 million. Two areas of uncertainty, what will happen in the market, and what will happen.
Sherry, will you ask her to repeat or just be quiet for a moment so we can get this? We can't hear you.
We can't hear you,
Yeah, you're
Melissa.
breaking up a little bit, Melissa, from time to time.
Try again.
Yes. All right, go ahead, try it again, Melissa.
Okay, how does this sound?
That sounds good.
All righty. Let me go over that OPEB analysis projection from the top. Last year, the OPEB fund recorded and received $8.1 million in revenues. We had a really strong year in terms of the market. That $8.1 million included market gains of $1.5 million. We know that can vary from year to year. We also had a good year in terms of our budget surplus. We had excess funds greater than 10.5%. That allowed us to make an additional contribution to the OPEB fund, and that's $1.1 million. So just those two revenue sources alone, $1.5 million in gains and $1.1 million in supplemental OPEB contributions, that's $2.6 million of what we received last year, is always uncertain when we start the year, okay? So for the first month, we have $200,000 in revenues, and I tend to take a conservative posture on projections when we only have 1 month into a fiscal year. So looking back in terms of what we could potentially see in a supplemental application under the Ordinance 10-52, starting off the year with a conservative assumption of $750,000 as compared to what is was $1.1 million last year. We are in the process of closing books for fiscal 25, so it's still a bit uncertain. So some conservatism is appropriate. We fully met our budget contribution. And when we think about gains, market gains, you know, we've had years that are we've had years at 1.5, we've had years that are negative. We're going to start off the year with a $500,000 projection and continue to monitor.
Yeah, Melissa, for some reason,
It's squeaky.
at times you're clearer, and at times it's, kind of like high pitched and chirpy. And,
How does that sound?
Yeah.
Is this a little better?
yeah, that's
Much
good,
better.
yeah.
Better? Okay. All right. All right. So we start off the year with a conservative projection on revenues of $6.4 million as compared to $8 million last year. And again, the variables that are impacting that are what will happen with the market and how will we close fiscal 25's budget, and to what extent will there be any excess to transfer into this fund. So we start off with a projection of $6.4 million. We, in the current year for July, for 1 month, we had $600,000 of expenses for the month of July. As you know, there's some seasonality to claim spend. This was a little bit on the higher side for the month of July. Our total expenditures last year was around $5.5 million. The current projection, just based on 1 month, is $6 million in expenditures. This will change. You'll have peaks and valleys, each month. But since we saw a little bit of a high in July, it's pushing our projection up a little bit for the year to $6 million. If you take our projection of $6 million and the $600,000 that we've experienced for the month of July, we're projecting in total $6.6 million against revenues of $6.4 million. So that would, indicate a small shortfall, but it is very early. I think it's best that we put the most honest projection out for the fund based on the data we have to date, and we'll obviously continue to monitor. The factors that will impact the projection, again, are market performance, the extent to which we have a surplus in fiscal 25, which still remains to be seen, and what is going to happen with claim spend. So as of now, we do project a small tapping of fund balance, but that would still leave us at June 30, 26 with about $17 million in the fund. And as you know, as we think about fund balance for OPEB, we've made great progress at $17 million, but we know to fully fund OPEB is, north of $100 million. So we're making progress. I like to make sure that for public participation, folks understand that it's a much larger commitment to meet what we have made commitments to in our contract. But overall, we're off to a decent start. Lastly, I just want to kind of show you the bottom of this page here, reminding you that we've continued to make good progress on our claim spend. You can see average monthly claims for fiscal 26. They are up $398,000 as compared to fiscal year 25 at $305,000. We have enjoyed some lower claims, right? Coming out of COVID, we know we were seeing average monthly spend of over $500,000, and it went down to $456, $381, and $305. So to see this spike up to $398 is kind of might be a normalization of claim spend. But again, it's 1 month into the year. We will continue to monitor. So that's the report out for the OPEB for the month of July. You have a balance sheet for the OPEB fund. Again, just tying back to the first page in the report, and it shows on revenue control, revenues of $190,000, and expenses in the month of $600,000. Then turning to your year-to-date budget report, you have a full breakdown of all revenues by type and all expenses by type. Again, just showing revenues of $190,000 and expenses of $602,000. All right, now turning to our pension trust fund. First up is the balance sheet for the month of July. When we include our drop investments, which is $18.2 million, we have a total of $281 million in assets that are under management. Our revenues for the month, you can see under revenue control, $1.8 million, and our expenses, $3 million. We spend approximately $3 million a month. Continuing to our year-to-date budget report, the main revenues for the month would be gains. So you can see the $1.1 million, that's revenue, that's market gains. Interest income of $369,000, and then we have $280,000 of employee contributions for a total of $1.8 million. On the pension expenditure side, $3 million, essentially, those are our pension payments for the month of July. All right, next month you'll see a significant increase in revenue again because the report will reflect the payment of our annual contribution. And finally, turning to the last page in your report, we have expenditures of $125 for the month of July, and I'm going to dig into that a little bit further just to this is likely a payment for June, but based on the timing of when the payment was made, it was paid in July and therefore is a July expenditure. And so that summarizes the report, and I'm happy to take any questions.
Any questions? Melissa? No? Harry?
Hello?
Yeah.
Can you guys hear me? Were there any
Yeah,
questions in the room? It's kind of hard to hear you, Marcus.
Oh,
No.
there were no questions in the room. Do you have any questions?
Yeah. So Melissa, thank you for the overview. And I think the other, your note around the claim spend, possibly renormalizing at a slightly higher amount. Do you think that we could, would we require kind of any changes to strategy or any thoughts if it were to continue on this trend throughout the rest of, let's just focus on this next fiscal year or current fiscal year?
Yes, well, Tyron and I and the team, we always have our eye on opportunities to achieve cost savings, and that's not necessarily in changing benefits, but how do we provide benefits in a more cost-efficient manner? And so you'll recall one of the improvements we made last year is we were able to move some of our retirees onto a fully insured product for prescriptions, and that brought in some savings. So anytime our broker identifies those sorts of opportunities to drive down cost, we're at the table and we're always ready to implement. We meet quarterly. We monitor the trend on expenditures. So we have our eye on what we're experiencing. The other thing that we could be seeing is some high cost claimants, right? We don't see the insurance for stop loss kick in until we hit a certain expenditure level. So that could also make July look like a higher expenditure level than we would likely see maybe when we get to December and some of those individuals in our population that might be facing medical issues that are costly. Then you'll start to see some savings come in because then the insurance kicks in. So I think it's early at this point. I'm not concerned at this point. 1 month in, once we get to through the first quarter, we'll certainly have a better indication. Obviously, if we see this claim trend continuing, it does put some pressure on us to think about our contribution. We've always, for the past couple of years, we've had a little extra cushion in there because we've had favorable conditions. Good surplus in the general fund, excess over the 10.5%, coupled with a strong market. So we know that those two factors allow us to build fund balance. So absent that, we probably would be a little bit tighter, but we could meet current cost. But those two non-recurring events, essentially, you can't guarantee every year you're going to have that excess on the fund balance. You can't every year you're going to have a great market performance. That's for that reason we've structured this really well, and that's that we want to use those monies to build fund balance and really not to cover recurring costs. That's the responsible best practice principle, if I would say, on how to manage an OPEB trust fund. So we got to keep our eye on this, and if we have to make some adjustments, we will.
Awesome. Thanks, Melissa. I think, as usual, you guys are attacking it from all angles. And I guess I could ask a million questions on this, but when is that next quarterly meeting? Because maybe you can bring some of that discussion to whatever the following pension board meeting is. I think that'd be good context to understand.
Okay.
Yeah, thank you.
Absolutely. You're most welcome. We'll do that.
Any further questions? Esther has a question, Melissa.
You indicated that there was a claim for the month prior, but it was paid in a different month. Is that a situation that occurs frequently?
Esther, I can't hear you very well, but from what I heard, it sounds like you were making a comment regarding maybe the retirement board budget report.
No, a claim on the medical side, it's appeared, or whatever it is that the claim was. you indicated that we didn't pay the claim until the month of January or February, just wondering about July, beginning of the new fiscal year. And it sounded as though it belonged in last fiscal year. And I'm looking to see
Right.
whether or not it's something that you do frequently.
So when I was making that statement, I was referring to the retirement board report, so where we pay our clerk essentially, because it's there's one payment in there, and that is for given that you are tonight going to approve. It looks like that is probably July's meeting. That's probably a misstatement on my part. But there's one month of payment, and that's probably the July meeting. So that is proper. July expenditure in the month, being recorded in the month of July. That's absolutely fine. Sometimes what happens with salary expenses is that let's say there's a board meeting on June 28th, and by the time the paperwork gets submitted, it crosses over the fiscal year. That's what I was referring to. But now that I'm thinking about it in retrospect, the July meeting, certainly at this point, our clerk would have already been paid, so that's appropriate.
I understand.
But as far as claim spend, for claims, no, our claims costs are actually debited. Anthem debits directly from our bank account on a weekly basis. So they are paid in the fiscal year. And for expenses of that magnitude, even if the bill is paid after June 30th, it has to be accrued back to the fiscal year. So, you're talking about hundreds of thousands of dollars. So that would be a material number that has to be, reported back into the fiscal year where the expense really belongs.
Right. Okay, thank you.
Now Ellen has a question.
What's your threshold for material to accrue back?
The auditors, well, they do not show their cards on at what level would you not meet the materiality threshold, thereby you'd have a finding. So for the town of East Hartford, while we communicate that our last check run is in the month of August, if I find an expenditure that's greater than $10,000 and it's in the month of June and I have not fully closed the books, we will record that expense in fiscal year 25. We don't get a lot of them, so it's not only just the amount, it's the volume of them, because a large number of 10,000s could add up. We're usually fine, it might be something for $5,000 here and there, but the volume is not significant.
Good. Lucky you. Thank you.
All right, any further questions? Okay, we'll be fixing that.
A handout, I think, for those on the phone. I think Oksana had sent out the checklist. You might have two there. Yeah. Good to see everyone again tonight. We'll kind of get you caught up on the fixed income side of the ledger for the two retirement accounts. And as we do each month, we'll start on page 2 of the flash report. And before we look at some of the particular numbers, just maybe a couple of overarching comments for the board to think a little bit about. You've certainly been, I think, reading about this and have a good sense of it. So the economic backdrop continues to be a bit unsettled. Right, as you've read, we have some good economic data and then some not so good economic data. We go back and forth. The second quarter number for GDP growth was 3%. After Q1, where we consolidated about 0.5%. The inflation metrics, both the headline numbers and the preferred measure that the Fed uses, which is the Personal Consumption Expenditure Index, both still running higher than the 2% target. We've read about a lot of challenge to Fed independence, and the administration may be tinkering with that a little bit. And as recently as this week, you saw some back and forth with one of the governors and trying to remove that individual. So there's kind of an undersettled undercurrent in markets right now, at least on the interest rate side of the ledger. When you look at predictions, most investors in the market expects the Fed to cut in September. It's a pretty high probability they'll cut 25 basis points in the month of September. I think it's up somewhere close to 90% this time I looked. the month of October, it comes down to about a 50-50 chance for an additional cut, and then in the December meeting, a smaller, maybe a 1 in 3 chance for a cut. So the markets are anticipating interest rate cuts in the coming months, and that's something, as you know, that the Fed, for a whole host of reasons, the inflation data in particular, have been pretty steadfast on leaving rates where they are. It's just an exception or two along the way. So there's a lot on the fixed income side of the ledger to unpack for sure. You see on page 2, third column in from the left, like we do each month, just give you a quick snapshot of what went on in the bond markets. Melissa alluded to that in her report, but interest rates did move a touch higher in the month. Remember, that's a headwind for fixed income total returns. So you see the broad markets were down about 0.3%. They're still holding up calendar year to date as a positive number. Everyone sees the 3.7% number there for the 7 months ending in July. So, markets continue to grind along on the fixed income side of the ledger. If you look at page 3, look on the exhibit on the left-hand side, just so you see some of the numbers there. You'll remember this is where we catalog at the beginning of the year and then month-over-month changes in interest rates. If you can all make it out there, you see the black line is the end of July data for interest rate, Treasury yields, and then the lighter blue line is the prior month. And you do see how rates did move up a measure in the month of July, as we talked about. So that, again, was a bit of a headwind for fixed income total returns. The other contributor or factor, as you know, is where spreads are. Incremental spreads over and above treasuries for both investment grade and high yield. And if you look on the right-hand side of page 3, you'll see in the upper right-hand corner, we show you there both kind of in graphic form and then the numbers themselves. Spreads continue to be very well behaved, right? I think despite some of those headline risks economically, there's a lot of confidence in corporate financial health and earnings capability and cash flow generating ability, the ability for those issuing some type of bonds to service those bonds, and we've had very good and solid and consistent spreads over the bond treasuries. And when Matt showed you just a minute some of the returns for the managers, that was a contributing factor to the incremental returns we saw in what was otherwise a challenging month for fixed income given those high rates. That enough for any questions from I don't know, Harry, Melissa, members here in the room? Just big picture stuff on rates? Generally make sense? Good. If something comes up on that side, let us know. And Matt's going to go over, give you a little bit of color on pension assets. We'll look at, and as we work with Freedom, we'll look at the aggregate pension numbers for the month as well. And then we'll go in and do the same on the open.
Perfect. Good evening, everyone. If we just turn to page 7. And we'll start, as we normally do, upper left-hand side of the page. You'll notice for the month, the portfolio was down slightly, about 0.1%, slightly ahead of benchmark. As Chris mentioned, the broad fixed income market was down about 2%. But when we look at the longer dated time frames, you can see the portfolio has done quite well. Ahead of benchmark across all reported time frames. And just two numbers here, or time frames. Looking at the 1-year number, you can see a 4.1% versus the benchmark at 3.3%, and then annualizing over the last 3 years at 2.6% when the broad fixed income market was up 1.6%. Looking at the upper right-hand side of the page, you can see that the portfolio finished off the month of July at $92,733,000. So a slight loss, as we just said, approximately $70,000. We ran the balances through last night's close. Alyssa mentioned that the appropriation was made, so we received roughly $5.1 million of that. But in excess of that, the portfolio is actually up about another percentage point. So we're up again in the month of August, which is great overall. And then just moving ahead, slide 9, all the managers in the pension portfolio have our manager research maintain status. We don't have any recommendations for today. So just looking at just a couple of the managers, one of them in particular, you'll see Loomis Sale investment grade bond. Chris mentioned that, spreads were very well behaved. They compressed more in a month. Credit did better than treasuries. For that manager really, really focused on the credit side of the ledger. You can see broad fixed income market was negative 0.2%. They were actually flat. We go over just two columns. Looking at the year-to-date time frame, up 3.9%. Broad market was up 7%. So nice performance there. And then just lastly, I feel like we talk about it every month. BlackRock, this unsettled rate environment, they continue to perform quite nicely. And you can see they're actually up for the month 2%. And then across longer dated time frames, such as the year-to-date time frame, up 4.8%. Broad market was 3.7%. Once again, small exposure to high yield. High yield has done quite well. Year-to-date in the 1-year time period. The exposure to credit has done quite well. Any questions about performance of the pension plan or the managers, or Chris touches on the aggregate? So.
All right, so jump in as always if something comes up. Turn to page 10 if you would, please. And we'll start in the very upper right-hand corner. Again, Melissa made reference to this, but I think it is good context for the last couple of fiscal years. So you can see 4 columns in from the right, upper right-hand corner of the page, the fiscal year ending June 2023. You can see that the total pension plan had a return of 8.4%. The fiscal year ending in June 2024, a return of 10.4%. And then it's not on the page here yet, it will be next month. Remember the month ending in June that we reported on last month, up 12.2%. So you've now kind of run off 3 consecutive fiscal years, right, where you've had really good incremental results from the pension plan, which is encouraging. And certainly, what collectively working with the Freedom folks we're aiming for. If you go down that same column and work your way to the upper left-hand corner, just to make reference to what happened in July, you'll see we've got the invested asset total about a 0.6% return for the month. Anyone see that number there? You can see as you work your way down that column, we talked about fixed income being flat down a little bit. Ben and John will talk about the equity markets, of course, but particularly the domestic equity markets had a decent one. You contributed to some of that aggregate return. So, an okay start to the new fiscal year, right? We can get 1% a month and do that for 12 months. You get the number at the end, right? That is certainly what you're hoping for, and then some. So, I think we're in pretty good working on that front, but I'll pause and see if anyone's got questions or thoughts or comments. All right, well, then Matt's going to jump over to the OPEB catch up and then turn it over to the Freedom folks.
Jumping ahead to slide 15. As a reminder, these portfolios are not invested in the same fashion from asset allocation or manager selection, but they do rhyme, so the overall performance patterns are very similar. So upper left-hand side of the page, you can see for the month the portfolio was flat. Broad market, as we discussed, were slightly negative for the month. Then longer dated time frames, similar story. The 1-year number up 4.7%. Broad market is up 5%. And you can see nice outperformance versus blended benchmark across all time frames. Looking the upper right-hand side of the page, the portfolio finished off the month of July, just north of $7 million. So nice overall purpose level there, as Melissa discussed as well. Contribution was made in the middle of the month. We received just shy of $1.1 million of that. Invested across the portfolio. So when we factor that in, the portfolio is also up 1.2%. Similar story to the pension plan. All the managers in the OPEB portfolio have our maintained status, no recommendations. Questions? If not, I can back over to Chris and go over the combined results for the OPEB.
And we'll be quick on page 18 of the report. We've got the exhibit here. Remember, we began to catalog the combined performance much more recently than we had for the pension. We'll start to catch up with a lot of data here over time, but just to give you an appreciation, again, not in this exhibit, but the fiscal year ending in June, when we said pension was up 12.2, the OPEB was up about 11.8%, fiscal year ending in June. And then similar, right, as mentioned, the allocations are identical, but they're close, and you see there the month, in aggregate sense, about a 0.5%, 5% for all the assets in the OPEB trust equity included together. So again, off to a constructive start in the new fiscal year here as well. I'll go through the chair. If there are any questions or thoughts or?
Questions in the room, any questions on the phone?
No questions, thank you.
All right, we'll move on to Ben and John.
All right, thank you. So as Chris and Matt mentioned, the town's contribution was received earlier this month. We split it up, worked with the fiducian folks, kept a chunk of it in cash so that we've got the next 3 months in the bag and not exposed to market risk at all. So, and then split the remainder. But we can report down to the penny on that in September after the end of August, which is looking like a decent month, knocking on wood for those other. Page 2 here simply shows the very boring chart. It's split about 65-35 U.S. to foreign equities at this point, which is on target. This is just showing the equities in general. The next page with the green circle in it is the cash. We had very low cash at the end of July after the July payment, and that was kind of by design because we knew the town contribution was coming in August. So, like I said, we refreshed the cash management account and then split the remainder to bring the plan itself back to 65% equity, 35% fixed income for the investment policy. So, and then the next page is simply the OPEB where there is no separate cash management account, so you see a small cash allocation within the equities portfolio there of about 1.5% versus 98.5%. The next page with the green and blue showing pension plan and the OPEB plan. The first column on the left numbers is the fiscal year to date, which is the same as the 1 month number in this particular case, but we see the plan up just under 1% on the equity portion, and then up about 35 basis points on the cash management portion. And then the OPEB plan in blue below that is approximately the same. In our case, you manage the two similar. Using ETFs, it's kind of easy to get granular even in the smaller account. So the only big difference really between the two plans is the fact that the pension plan does see more cash flow because we do add to and then liquidate from the equity portion of the two accounts to fund benefit payments on a regular basis. I will let Ben go through the individual asset classes and geographies on the last page of the report there.
So turning to the next section where we break down the equity performance between U.S. equities, international developed in blue, and emerging markets in orange, we can see that was a very strong month for the U.S. market overall. The MSCI U.S. Broad Market Index was up almost 2.3%. However, I would say that much of that was being driven by a sharp rally that we've seen in the technology growth space, both in large caps and in particular small cap growth. So-called meme stocks, or the most unprofitable, the lowest quality segments of the U.S. small cap market really drove the overall equity market advance. So not only was it narrow, but it was very concentrated in the most speculative areas of the market, and a lot of that's just premised on technology spending. There continues to be excitement over how much artificial intelligence spending is driving overall hardware capital expenditures. You heard that from the earnings calls of the large hyperscalers like Meta, Amazon, Microsoft, even Apple is increasing their capital spending. What's interesting is that they really are viewing this as an arms race. And so as a result, much of their free cash flow and profits that they've enjoyed dominating their respective markets are being deployed into capital spending. So it's high risk, but they see it as high return or even an existential issue related to their ability to remain competitive in this emerging technology landscape. I will say that August has seen a reversal of that. So we've seen the more boring segments of the market, like healthcare, lead market performance in August. So some of that we're seeing a bit of a reversal on. It is somewhat headline driven, concerns around what the Fed was going to say at Jackson Hole. We'll talk more about what the Fed did in next month's meeting, but as Chris alluded to, September rate cut is now considered the base case. The only question is will it be a hawkish cut or a dovish cut? And much of that will depend on the upcoming labor market and inflation readings that we will get before the September FOMC. If you look down the list here, though, you can see that really it was a large cap that performed well, led by the U.S. equity market ETF. Value, as proxied by the Vanguard Value ETF, lagged. But as I said, we're seeing a reversal of that in August. So overall, on an absolute performance basis, the U.S. equities performed well, just lagged the overall market because of that growth bias that drove market performance in the U.S. And then in international, we saw international failing to keep pace with the U.S. markets, which is the first time we've seen this in quite some time this year, because international markets year to date have been dominating overall performance. But you can see that on a relative basis, unlike what we saw in the U.S. markets, value and small caps performed relatively better than the overall broad market index as represented by MSCI EAFE. International core equity with its tilt towards value and small caps outperformed, as did the international value ETF, and small caps also outperformed. And then emerging markets, it continues to be a China versus non-China story. And in the case of July, just like how technology drove gains in the U.S. market, it's pretty much been a China tech-driven story as they try and keep up with their own arms race in the technology and AI spending, and that helped propel overall performance. So even though on an absolute basis emerging markets performed well, much of that was being driven by China, whereas value and non-China segments of the market lagged the overall index. And with that, I'll take any questions about what's going on in the markets. August has been actually a pretty quiet month, believe it or not.
Yeah.
I will say, if you look at big picture what's going on, we are, through Trump, whether you agree with him or not, this has been the most, what I would call, proactive industrial policy government that we've seen in quite some time. So normally what would happen is Congress would pass huge fiscal largesse, particularly after the pandemic, and just distribute it out to the states, to companies, whatever, and not really have a very active say in policy setting and policy direction. You're not seeing that with this administration. To give a good example, this month they extracted a 10% equity stake in Intel. They didn't, according to Trump, they didn't pay anything for it. The reason why they didn't pay anything for it is because they made that part of the CHIPS Act. So what they said was, okay, Intel, we gave you or allocated, earmarked so much money to spend on semiconductor manufacturing and promoting spending within the U.S., that in return you owe us a 10% equity stake in it. And they gave it. That is very unusual. It's probably something we've not seen in quite some time, but that is kind of an example. Another example is Trump demanding a 15% tariff on any NVIDIA H20 chips being sold to China. So basically, we're going to extract 15% of all chip revenue that you sell to China. Again, very sort of proactive, some would say over-interventional style of, interventionist style of industrial policy setting, but that's what we're seeing. And it raises uncertainty as to what the U.S. government policy shifts are and so forth, but really the broader objective in all this is just recognizing that the U.S. has security, geopolitical security interests that are more intertwined with private industry, in particular the technology industry. And they really view this, I said it was existential for someone like Meta to spend as much money as they are on capital, on data center build-outs. Well, the U.S. also sees this as an existential threat vis-a-vis China that's also spending large amounts of money on this. And so they are really pushing themselves to be more, as I said, interventionist in their approach to setting industrial policy. But expect see more of that. Another good example, I'll just bring up more, is India. So last night, India's tariffs doubled. I think they went up to 25%. In some cases, they went up to 50% because of the Trump administration's insistence that they curtail their purchase of Russian oil. So India is purchasing Russian oil, but they're doing it under the price gaps imposed by Western Europe and also by the U.S. So really, they're not violating any existing sanctions. They just continue to prop up the Russian oil market because they are purchasing oil and then they're reselling it back to Europe at a market. And Trump doesn't like that, and so he's made trade policy negotiations with India contingent on what they do with Russian oil purchases. And India is not budging, and so as a result, tariffs went up on India. Now, most of the trade activity we see with India is not in goods, but it's in services. I have to look back to see whether the tariffs are impacting the services component of what we get from India. But clearly, it's another example of intertwining sort of geopolitical interests with economic policy and industrial policy.
Questions? Any questions on the phone for Ben or John?
No questions.
No questions here. Thank you. Appreciate the overview.
All right, we'll move on to communications. We have 3 individuals retired from the police department: Jason Kaplan, Dave Rhodes, William Sprague. 3 individuals entering the drop program from the fire department: Chad Goodwin, Josh Lecker, John Burrell, and Board of Education. Expect retirements: Lisa Merzen, Russell Valentano, and Virginia Gadja, going for Sagaya. Let's have new business. Do we have any new business? Let's have old business. Here's the old business. Not seeing any approval of disbursements.
Approved $125 payment for clerk.
We have a motion and a second to pay the clerk. All in favor? Any opposed? Next item, questions by board members. Are there any questions by board members?
Hello?
So, yeah, Harry?
Yeah, hey, I'm not there, but you said there was a guest in the room. Who was that?
Florence Owen. Florence Owen. She's here as a resident.
What's your name?
I can't hear anything that everyone's talking at the same time.
Harry, it was Florence Owen. Oten, and she is the Republican candidate for treasurer.
Okay, thank you.
Before we adjourn, there's been a request that we possibly move our meeting in September to an earlier time, 5 or 5:15, due to a conflict among clerks. Did anybody have any opposition to work?
I'm September, sorry, what was that date?
Should I push for it? Okay, for the purpose of those on the phone, we're trying to see if we can move our meeting in September to 5 o'clock to accommodate the conflict. Is there any opposition or, check our calendars?
Was that,
Okay.
could you elaborate on what that problem is?
I can speak to it, you can speak to it.
Yeah, there's back-to-back meetings that day, and planning and zoning and wetlands have moved their meetings, all of their meetings up to 6:30. So I've been asked to cover that meeting as well as this one. And for me to do this one at 5:45, I can't, because their meetings last longer than 45 minutes. So I'm just asking if not, then they will have to get a substitute.
Okay, for those on the phone, we have agreement in the room amongst myself, Ellen, and Esther that we can make the 5 o'clock. Our gentleman on the other side, good on the, listen to that, solutions folks. How about the freedom folks are good? All right, Melissa and Harry, how are you guys for 5 o'clock on the September 24th?
Concerns on my end, Harry? How's that for you?
Yeah, I mean, I'll make whatever time. I think I gave it a thumbs up, so good.
Good. Okay. Okay, thanks everybody. We'll make that change. Okay, noted. There a motion for adjournment?
Motion to adjourn.
There a second? Seconded. All in favor?
Aye.
Opposed? All right, we'll see everybody next on September 24th.
Have a good night, folks.
All right. I was